Chapter 1. Introduction to the World of Forex. Imagine a marketplace that never sleeps. A digital colossus where over $6 trillion change hands every single day. This is the foreign exchange market, or Forex, the largest and most liquid financial arena on the planet. While the stock market often captures the headlines with its shouting traders and iconic bell rings, Forex is the quiet engine of the global economy, humming beneath the surface of every international transaction. It is the invisible bridge connecting a Japanese tech giant buying parts in Germany to a vacationer exchanging dollars for euros at a London airport. In this domain, currencies are not just money, they are the commodities themselves, fluctuating in a relentless tug-of-war driven by geopolitical shifts, economic data, and human psychology. To understand Forex is to understand the history of global trust. Long before high-speed fiber optics and algorithmic trading, international commerce relied on the gold standard and rigid agreements between nations. However, as the world moved toward floating exchange rates in the early 1970s, the modern Forex market was born. It transformed from a restricted club for central banks and massive corporations into a decentralized global network. Today, there is no physical building for the Forex market. Instead, it exists as a sophisticated web of electronic connections, spanning time zones from Sydney and Tokyo to London and New York. This unique structure allows it to operate 24 hours a day, 5 days a week, ensuring that the sun never sets on the world of currency trading. The scale of this market is fueled by a diverse cast of players, each with different motivations and levels of influence. At the top of the pyramid sit the central banks, the architects of monetary policy, and the interbank market, where massive commercial banks trade billions in a heartbeat. Beneath them are the institutional investors, hedge funds, and multinational corporations hedging against price fluctuations to protect their profits. Finally, there is the retail trader. Individuals like you, who use technology once reserved for the elite to find opportunities in the market's movements. As you step into this world, you aren't just looking at numbers on a screen. You are participating in a global conversation about the value of nations. As you embark on this journey through the Forex Blueprint, your first task is to strip away the myth that trading is a game of chance. Treat this marketplace as a vast, logical curriculum where price movements are the language of global health. In the pages that follow, we will break down the mechanics of the pip, the dynamics of currency pairs, and the fundamental forces that drive the world's most powerful economies. The scale may be intimidating, and the pace may be fast, but by understanding the landscape of this global marketplace, you are laying the foundation for a disciplined, strategic approach to financial freedom. Chapter 2. The Mechanics of Currency Pairs. In the world of conventional shopping, the transaction is straightforward. You give away money to receive a tangible item, like a cup of coffee or a new pair of shoes. In the foreign exchange market, however, money is both the payment and the product. Because you cannot buy a currency without simultaneously selling another, every market movement is expressed as a relationship between two players. This is why you will never see a single currency listed alone on a trading platform. They always travel in pairs, locked in a perpetual tug-of-war that determines their relative value. To navigate this market, you must first master the anatomy of a currency pair. Every notation, such as EUR USD or GBP JPY, consists of two distinct parts, the base currency and the quote currency. The first currency listed is the base, and it serves as the foundation of the transaction, representing exactly 1 unit of that currency. The second is the quote or counter currency, which represents how much of that currency is required to purchase a single unit of the base. If you see EUR USD trading at 1.10, the market is telling you a simple story. It costs exactly 1.10 US dollars to buy 1 single euro. Understanding this hierarchy is the key to interpreting market momentum. When you go long or buy a pair, you are betting that the base currency will strengthen against the quote currency. Conversely, when you short or sell, you are predicting the base will weaken. This standardized notation ensures that whether you are at a desk in London or a cafe in Tokyo, the language of the trade remains universal. It transforms a chaotic global exchange into a clean, mathematical ratio that you can analyze and exploit. However, not all pairs are created equal, and they are generally categorized into three distinct tiers based on their liquidity and stability. The majors are the titans of the industry, pairs that always include the US dollar coupled with another heavy hitter like the euro, the yen, or the British pound. These offer the lowest transaction costs and the most predictable movements. Minors, or crosses, consist of major currencies traded against each other without the US dollar involved, while exotics pair a major currency with a developing economy's currency, such as the Turkish lira or the Mexican peso. As you begin your journey, learning to distinguish between these categories will help you decide where to focus your capital and how much risk you are truly willing to invite into your portfolio. Chapter 3. Navigating market sessions and timing. The rhythm of the foreign exchange market is a relentless, 24-hour pulse, but to the untrained eye, it can feel like a chaotic ocean without a tide. Unlike the stock market, which keeps strict business hours, Forex follows the sun as it travels across the globe. However, just because the market is open doesn't mean you should be trading. Navigating the Forex landscape requires an understanding that there are moments of explosive opportunity and stretches of stagnant silence. To master the when of trading is just as vital as mastering the how, as your success depends entirely on the presence of liquidity and volatility, the lifeblood of any profitable move. The global trading day is traditionally divided into four major sessions: Sydney, Tokyo, London, and New York. Each of these financial hubs brings a unique personality to the charts. The Sydney and Tokyo sessions, often referred to as the Asian session, are generally characterized by lower volatility and steady consolidating movements. As the sun sets in Asia, the big smoke wakes up. The London session is the undisputed heavyweight champion of the Forex world, injecting massive volume and trend-setting momentum into the market. Finally, the New York session joins the fray, often providing the final push of the day or a dramatic reversal of the morning's moves. The true magic for a trader, however, happens during the overlaps, those golden windows when two major sessions are open simultaneously. The most significant of these is the London-New York overlap, a 4-hour period where the world's two largest financial centers are battling for dominance. During these hours, liquidity is at its peak, spreads are at their narrowest, and the price action is most reliable. This is when the big players, central banks, hedge funds, and institutional giants, are most active, creating the trends that beginners can learn to ride like a wave. Timing your entry into the market is not merely about convenience. It is a strategic decision that dictates your probability of success. Trading during a dead session is like trying to sail a boat in a doldrum. You can sit at your screen for hours and see no movement, only to be hit by a sudden, unpredictable surge when the next session opens. By aligning your trading schedule with these high-energy windows, you ensure that when you do decide to place a trade, the market has the necessary fuel to move the price toward your profit target. Chapter 4. The language of Forex: pips, lots, and spreads. Imagine stepping into a high-stakes auction where everyone is shouting in a dialect you've never heard. You see the intensity on their faces and the flicker of numbers on the screens. But without knowing the dialect, you are merely a spectator, unable to place a bid or understand the value of what is being sold. In the world of Forex, this dialect is composed of pips, lots, and spreads. These aren't just technical buzzwords designed to make trading sound sophisticated. They are the fundamental units of measurement that dictate your profit, your loss, and your very ability to navigate the market. Before you can master the art of the trade, you must master the vocabulary of the exchange. The heartbeat of every currency move is measured in pips, an acronym for point in percentage. For most currency pairs, a pip represents the fourth decimal place, 1/100th of 1%. It may seem like a microscopic shift, a mere fraction of a cent, but in the leveraged world of Forex, these tiny increments are where fortunes are forged. When the euro climbs against the dollar from 1.0850 to 1.0851, it has moved exactly 1 pip. Understanding the pip is your first step toward precision. It allows you to quantify market volatility and, more importantly, define the exact moment a trade turns from a hypothetical idea into a tangible gain. However, a pip's value is meaningless without the context of volume, which brings us to lots. If the pip is the distance traveled, the lot is the size of the vehicle you are driving. Trading a standard lot, 100,000 units of currency, means that a single pip move can represent $10. Trading a micro lot, conversely, reduces that same move to pennies. This relationship between price movement and position size is the engine of your trading account. It is here that beginners often stumble, failing to realize that without calculating the value of a move beforehand, they are essentially flying blind into a storm. Finally, we must pull back the curtain on the spread, the hidden cost of doing business. In the financial markets, nothing is free, and the spread is how your broker takes their seat at the table. It is the razor-thin gap between the price at which you can buy a currency and the price at which you can sell it. Think of it as a small toll you pay every time you cross the bridge into a trade. By understanding how pips, lots, and spreads interact, you move from being a confused outsider to a fluent participant, ready to calculate your risk with the clinical accuracy required for long-term success. Chapter 5. Leverage and Margin, the Double-Edged Sword. To the uninitiated, the concept of leverage feels like a financial superpower. It is the mechanism that allows a retail trader with a modest $1,000 account to command the market power of $100,000. In the fast-paced arena of Forex, leverage is the ultimate equalizer, stripping away the barriers to entry that once kept the world's largest financial markets reserved for institutional giants and sovereign banks. It promises the allure of outsized returns on minimal capital, turning the smallest market fluctuations into significant financial events. However, the very mechanism that magnifies your gains holds an equal and opposite potential for destruction. Leverage does not discriminate between a winning trade and a losing one. Think of leverage as a high-performance engine. In the hands of a professional driver who understands the mechanics of the road, it provides the necessary torque to reach the finish line ahead of the pack. But in the hands of a novice, that same power becomes a liability. Margin serves as your good faith deposit, the collateral required to open and maintain a leveraged position, and it acts as the tether holding your account together. When you overextend that tether, you enter the danger zone of the margin call, a cold reality where the broker closes your trades to prevent your losses from exceeding your balance. Understanding the ratio between your used margin and your equity is not just a mathematical exercise, it is the fundamental basis of survival. The psychological trap of the double-edged sword lies in its invisibility. On your trading screen, a 100-to-1 leverage ratio looks like opportunity, but in practice, it means that a mere 1% move against your position could theoretically wipe out your entire investment. Respecting leverage means acknowledging that while you can control a large ship, you are still navigating an ocean capable of sinking it in seconds. Success in the Forex Blueprint curriculum isn't measured by how much power you can wield, but by how much risk you can effectively mitigate. This chapter will strip away the marketing jargon and provide a sober, step-by-step framework for calculating margin requirements and choosing a leverage level that keeps you in the game for the long haul. Chapter 6. Setting up your trading infrastructure. Before you place your first trade, you must build the foundation upon which your entire career will rest. Think of your trading infrastructure not just as a collection of apps and accounts, but as the physical and digital laboratory where your financial future is engineered. A pilot wouldn't dream of taking off in a plane with a faulty cockpit or an unverified flight plan. And as a Forex trader, you cannot afford to operate within a haphazard environment. This chapter is about moving from the theoretical world of charts into the practical world of execution, ensuring that when you finally pull the trigger on a trade, the mechanism behind the scenes is seamless, secure, and professional. The first and most critical component of this infrastructure is your broker, the gateway between your capital and the global markets. Choosing a broker is perhaps the most significant trade you will ever make, as it involves entrusting an institution with your hard-earned money. In a landscape filled with flashy marketing and promises of zero spreads, your first line of defense is regulation. A reliable broker operates under the watchful eyes of major financial authorities, providing a layer of protection against fraud and ensuring that your orders are executed fairly. We will strip away the marketing jargon to focus on what truly matters: capital security, execution speed, and transparent fee structures that won't quietly erode your profits. Once your partnership with a broker is solidified, you must master the tools of the trade. Whether you choose the industry-standard powerhouse of MetaTrader or the sleek, modern interface of TradingView, your platform is your window into the market's heartbeat. It is where you will perform the deep work of technical analysis and the high-precision task of order management. Setting up your workspace involves more than just downloading software. It requires creating a distraction-free environment that fosters discipline. This means technical redundancy, like a stable internet connection and a backup mobile device, balanced with a physical workspace that signals to your brain that it is time to perform. By the end of this chapter, you will transition from an observer to an operator. We will walk through a comprehensive checklist to ensure your infrastructure is battle-ready, covering everything from whitelisting your broker's support emails to configuring the essential indicators on your charts. Building a professional setup from day one does more than just facilitate trades. It builds the psychological confidence necessary to handle the volatility of the markets. You are no longer just practicing, you are setting up shop, and it is time to ensure your shop is built to last. Chapter 7. Reading the Charts. Price Action Visualized. To the untrained eye, a price chart looks like a jagged mountain range or a chaotic heart rate monitor, pulsing with unpredictable energy. But for the disciplined trader, these charts are more than just lines on a screen. They are the living, breathing footprints of market psychology. Every tick, every surge, and every plateau tells the story of a tug-of-war between millions of buyers and sellers across the globe. By learning to read these visual patterns, you are moving beyond guesswork and beginning to decipher the collective language of the world's largest financial market. Your journey into technical analysis begins with the three primary ways we visualize price: line, bar, and candlestick charts. While the line chart offers a simplified, big picture of closing prices, and bar charts provide a more detailed look at the price range, it is the candlestick chart that serves as the gold standard for most Forex traders. Originating from 18th century Japanese rice traders, candlesticks provide an immediate, color-coded glimpse into the battle for control. A single candle doesn't just show you where price started and ended. It reveals the wicks of exhaustion where one side pushed too far, and the bodies of conviction where a trend gained momentum. Mastering these visuals requires you to understand the concept of timeframes, the lens through which you view the market. Navigating between a 1-minute chart and a monthly view is like switching between a microscope and a telescope. The 1-minute chart captures the frantic, granular noise of high-frequency trading, perfect for those seeking rapid-fire opportunities. Conversely, the monthly or weekly views strip away the daily chatter, revealing the massive tectonic shifts in global economies. A blueprint for success involves aligning these views. You must learn to recognize that a small ripple on a 5-minute chart is often just a single drop in the ocean of a much larger weekly trend. As you begin to flip through different timeframes and chart styles, your goal is to develop chart vision. This is the ability to see past the flickering numbers and recognize the underlying structure of the market. You aren't just looking for high or low prices, you are looking for the story of the trend. This chapter will teach you how to calibrate your eyes so that every time you open your trading platform, you aren't just looking at a grid of data, you are reading a map that points toward the next major opportunity. Chapter 8. Mastering Candlestick Anatomy. Imagine walking through a foreign city where all the street signs, menus, and shop windows are written in a script you don't recognize. You can see the movement of the crowds and feel the energy of the streets, but you are fundamentally an outsider, unable to interpret the intentions of the people around you. For many beginners, looking at a live price chart feels exactly like this, a chaotic blur of red and green flickers. However, once you understand the anatomy of a Japanese candlestick, that illegible script suddenly transforms into a clear, vivid narrative. You are no longer just looking at lines on a screen. You are reading the collective psyche of the global market in real time. Every candlestick tells a story of a battle fought between two primal forces, the bulls and the bears. The body of the candle reveals who won the territory during a specific time frame, while the wicks or shadows represent the volatility and the rejected prices, the places where one side tried to push, only to be shoved back by the opposition. A long upper wick isn't just a line, it is a footprint of exhaustion, showing you exactly where the buyers lost their nerve. By mastering this anatomy, you learn to identify the subtle shifts in momentum before they become obvious to the rest of the world. As we dive into specific patterns, we begin with the doji, a candle where the opening and closing prices are virtually identical. This cross-like figure represents a moment of absolute indecision, a psychological standoff where the market is catching its breath before a major move. From there, we transition into powerful reversal signals like the engulfing pattern, where one side completely overwhelms the other, signaling a hostile takeover of price direction, and the pin bar, a deceptive candle that traps amateur traders before snapping back in the opposite direction. These aren't just shapes to memorize. They are the visual vocabulary of supply and demand. To master the Forex market, you must stop treating charts like math problems and start treating them like a dialogue. A single candle can whisper a warning or shout a command. In this chapter, we will break down the mechanics of these formations so that when you open your trading platform, you aren't guessing. You are listening. By the time you reach the end of these pages, the noise of the market will fall away, replaced by a strategic understanding of when to strike, when to hold, and when to wait for the next chapter of the price action story to unfold. Chapter 9: Trend Identification and Market Structure. The financial market is often described as a chaotic sea of red and green candles, a relentless pulse of data that can feel overwhelming to the uninitiated. However, beneath this surface turbulence lies a rhythmic architecture known as market structure. To the disciplined trader, price does not move randomly. It flows in cycles of expansion and retracement. Understanding this flow is the difference between gambling on a coin toss and navigating with a high-definition GPS. Before you place a single dollar at risk, you must learn to strip away the noise and identify the primary path of least resistance. In its simplest form, the market speaks in three distinct voices: an uptrend, a downtrend, or a range. An uptrend is a series of higher highs and higher lows, a visual staircase that signals buyers are firmly in control of the narrative. Conversely, a downtrend reveals itself through a sequence of lower lows and lower highs, where the weight of selling pressure dominates every attempt at a rally. When the market lacks a clear heading, it enters a sideways or ranging phase, bouncing between horizontal boundaries like a trapped bird. Identifying these environments with objective rules, rather than gut feelings, is the bedrock of your trading edge. To help visualize these structural shifts, we employ trend lines as our primary diagnostic tool. A well-drawn trend line acts as a diagonal floor or ceiling, connecting the pivot points of the market to reveal the strength and angle of its momentum. You have likely heard the old adage, "The trend is your friend," but the complete wisdom includes a vital warning: until the bend at the end. The goal of this chapter is not just to help you ride the wave, but to teach you how to recognize the subtle fractures in market structure that signal a reversal is coming. By learning to spot when a high fails to exceed its predecessor, you will be prepared to exit the stage before the curtain falls. Chapter 10: The Bedrock of Trading: Support and Resistance. Imagine standing inside a vast, multi-story building where the floor beneath your feet and the ceiling above your head are the only things keeping you grounded. In the chaotic world of the foreign exchange market, price movement can often feel like a frantic ball bouncing in an elevator shaft. Without a framework to understand where it might stop, start, or reverse, a trader is simply guessing. Support and resistance are the architectural blueprints of this building. They are the invisible psychological barriers where the collective sentiment of millions of traders shifts from buying to selling and back again. By identifying these floors and ceilings, you stop chasing the market and start anticipating its next move. At its core, support is the floor, where a falling price tends to stop and bounce back up. This occurs because buying interest is strong enough to overcome selling pressure. Conversely, resistance is the ceiling that prevents the price from rising further as sellers flood the market and overwhelm the buyers. These aren't just random lines on a screen. They are historical scars representing zones where the market previously decided that a currency was either too cheap or too expensive. Learning to draw these horizontal levels accurately is the first true step in moving from a gambler's mindset to a technician's precision. The true magic of technical analysis, however, lies in a phenomenon known as the role reversal. Price action is fluid. Eventually, a floor will collapse or a ceiling will be shattered. When a price finally breaks through a strong resistance level, that old ceiling doesn't disappear. It frequently transforms into a new floor of support. This shift happens because the market participants who missed the initial breakout are now eager to buy the moment the price dips back to that previous high. Mastering the ability to spot these transitions allows you to trade with the momentum of the market rather than fighting against it, turning former obstacles into your greatest advantages. Chapter 11. Trend Following with Moving Averages. In the chaotic sea of green and red candles, a trader's most vital task is to distinguish the meaningful signals from the background noise. Market prices rarely move in a perfectly straight line. Instead, they breathe, fluctuating with every minor shift in sentiment and liquidity. To the untrained eye, these jagged peaks and valleys can feel overwhelming. This is where moving averages become your most trusted navigational tool. By smoothing out the erratic price action into a single flowing line, these indicators act as a mathematical lens that filters out the market noise, allowing you to see the underlying trend with absolute clarity. The two primary instruments in your toolkit are the simple moving average, SMA, and the exponential moving average, EMA. The SMA is the steady veteran of the group, providing an equal weighting to all historical data points over a set period, making it ideal for identifying long-term structural shifts. The EMA, conversely, is the agile scout. It places greater weight on the most recent price action, reacting more swiftly to sudden changes in market momentum. Choosing between them isn't about finding a magic setting, but about deciding how much sensitivity you require to stay synchronized with the market's current rhythm. Beyond merely identifying the direction of a trend, these averages serve a dual purpose as dynamic support and resistance. Unlike traditional horizontal levels that remain fixed at a specific price point, moving averages travel alongside the price, evolving as the candles print. In a strong uptrend, you will often see the price pull back to kiss the moving average before bouncing higher, as if the line itself were a literal floor pushing the market up. By learning to recognize these touch points, you stop chasing the market at its peaks and start entering trades at the moments of maximum technical advantage. As you integrate these tools into your curriculum, remember that a moving average is not a crystal ball. It is a lagging indicator that reflects what has already transpired. However, its power lies in confirmation. It serves as a rigorous filter. If the price is consistently trading above a rising average, you are looking for buying opportunities. If it is trapped below a descending average, your bias shifts towards selling. By aligning your trades with these mathematical currents, you ensure that you are never swimming against the tide, but rather riding the momentum that the institutional big money has already set in motion. Chapter 12. Oscillators, Measuring Market Momentum. The market rarely moves in a straight line. It breathes, expanding with bursts of energy and contracting when that energy is spent. To the untrained eye, a massive price surge looks like an invitation to buy, but to a seasoned trader, it often signals the onset of exhaustion. This is where oscillators become your most vital diagnostic tool. Unlike trend-following indicators that lag behind the action, oscillators function as a market speedometer, measuring the velocity and magnitude of price movements to tell you when a trend is accelerating or when it is simply running out of gas. The Relative Strength Index, or RSI, is the cornerstone of this momentum-based approach. By scaling price action on a range from 0 to 100, the RSI provides a clear visual threshold for market sentiment. When the indicator climbs above the 70 level, the market is historically overbought, signaling that the recent buying spree may be overextended and a pullback is imminent. Conversely, when it dips below 30, the market is oversold, suggesting that the selling pressure has reached a point of saturation. These aren't just numbers. They are psychological markers that represent the collective stretch of the market before it snaps back toward its mean. While the RSI tracks the intensity of price changes, the stochastic oscillator looks at where the price closes relative to its recent range. This provides a more sensitive look at market turning points, acting like a high-precision sensor for the final flickers of momentum. When the stochastic lines cross deep within extreme territory, it's as if the market is flashing a yellow light, warning you that the current move is reaching a point of diminishing returns. Understanding these ebbs and flows allows you to stop chasing trades at their peak and start positioning yourself for the inevitable reversal. Mastering oscillators is about more than just reading a gauge. It is about recognizing the harmony between price and momentum. A common mistake for beginners is treating an overbought reading as an immediate signal to sell. True proficiency comes from watching how these indicators interact with support and resistance. By identifying exhaustion points, you gain the discipline to wait for the market to come to you, ensuring that you enter the fray only when the momentum is shifting in your favor. This chapter will deconstruct these mechanical tools, transforming them into a strategic lens for timing your entries with surgical precision. Chapter 13: The Power of Fibonacci Retracements. In the world of mathematics, the Fibonacci sequence is often called the fingerprint of the universe, appearing in everything from the spiral of galaxies to the petals of a flower. In the Forex market, this same mathematical harmony manifests as a powerful psychological phenomenon. Traders are not merely looking at numbers, they are observing the natural rhythm of human emotion, the push and pull between greed and fear. Chapter 13 introduces you to the Fibonacci retracement tool, a technical indicator that allows you to quantify these emotional swings and transform a chaotic price chart into a predictable map of potential turning points. Every major market trend moves like a tide. It surges forward in a dominant direction and then inevitably recedes. These pullbacks or retracements often leave beginners in a state of panic, wondering if the trend has reversed or if the market is simply taking a breath. Fibonacci levels provide the answer. By measuring the distance between a significant high and a low, the tool projects horizontal lines at specific percentages, most notably 38.2%, 50%, and 61.8%. These levels act as hidden supports and resistances, marking the spots where big institutional players are most likely to step back in and push the price further in its original direction. The heart of this strategy lies in what professional traders call the golden zone. While every level has its merit, the region between the 50% and 61.8% retracement levels is where the highest probability setups are born. When the price dips into this zone during an uptrend, it is as if the market has gone on sale, offering a discounted entry before the next leg up. Learning to identify this zone allows you to move away from chasing the price at its peak and instead start positioning yourself with surgical precision. However, the true power of Fibonacci is not found in using it in isolation, but in the art of confluence. A Fibonacci level is a suggestion, but when that level aligns with a previous area of support, a psychological round number, or a moving average, it becomes a high conviction signal. As you work through this curriculum, you will learn to see these clusters of evidence. By the end of this chapter, you won't just be drawing lines on a screen. You will be anticipating the market's next move with the confidence of someone who understands the underlying geometry of the charts. Chapter 14: Chart Patterns: Identifying High Probability Setups. To the untrained eye, a price chart looks like a chaotic heartbeat, a jagged sequence of peaks and valleys that seem to move without rhyme or reason. However, for those who know what to look for, these fluctuations are far from random. They are the footprints of market psychology made visible. Chart patterns represent the recurring battle between buyers and sellers, captured in geometric shapes that have signaled major market shifts for decades. When you see a specific pattern forming, you aren't just looking at lines on a screen, You are witnessing a collective emotional shift from optimism to fear, or from exhaustion to renewed vigor. Consider the head and shoulders pattern, perhaps the most iconic setup in the trader's arsenal. This structure doesn't exist by accident. It tells the story of an uptrend that has finally lost its momentum. The first shoulder shows a healthy rally, but the head represents a final desperate push to new highs that the market can no longer sustain. When the second shoulder fails to break that previous peak, it signals that the bulls have run out of steam. By learning to identify these visual signatures, you transition from someone who merely follows price to someone who anticipates where price is headed next. Similarly, patterns like double tops and double bottoms act as the market's line in the sand. These setups occur when price tests a specific level twice and is rejected both times, proving that the prevailing trend has met an immovable wall of supply or demand. Triangles, on the other hand, represent a period of compression, a coiled spring where the market is catching its breath and consolidating its energy. The tighter the triangle becomes, the more explosive the eventual breakout tends to be. These are not just shapes. They are high-probability setups that offer a clear roadmap for where to enter a trade and, more importantly, where to place your protection. The reason these patterns repeat with such uncanny frequency is rooted in human nature. Market participants tend to react to similar levels of fear and greed in the same ways, over and over again. While the names of the currencies and the economic backdrops change, the crowd remains the same. In this chapter, we will break down the mechanics of these classic setups, moving beyond the simple what and into the why. By the end, you will be able to scan a chart and see the hidden structures that precede the market's biggest moves, giving you the edge needed to trade with confidence rather than guesswork. Chapter 15, Fundamentals. Why prices move on a macro scale. While technical analysis allows you to read the footprints left by market participants on a chart, fundamental analysis is the study of the forces that create those tracks in the first place. Imagine the Forex market as a vast ocean. The daily price fluctuations we see as candles are the surface waves, often erratic and wind-driven. Fundamental analysis, however, looks at the deep-sea currents, the massive shifts in tectonic plates and global temperatures that dictate where the water is moving over the long term. To trade without understanding these drivers is to sail a ship without checking the weather forecast. You might survive a few gusts, but you will eventually be caught off guard by the storm. At the heart of every currency's value is the health of its home economy, and nothing signals that health more clearly than gross domestic product, GDP. As a beginner, think of GDP as a nation's annual report card. When a country is producing more goods, creating more jobs, and increasing its overall output, it becomes an attractive destination for foreign investment. To buy that country's goods or invest in its businesses, international players must first buy its currency. This surge in demand naturally pushes the currency's value higher. When you learn to track GDP trends, you aren't just looking at numbers on a calendar. You are measuring the underlying heartbeat of a nation's economic power. However, if GDP is the heartbeat, then the central bank is the brain directing the body. Institutions like the Federal Reserve in the United States or the European Central Bank act as the ultimate architects of currency value through their control of interest rates. This is perhaps the most critical macro lever in the world of Forex. High interest rates act like a magnet for global capital, offering investors a better return on their parked cash. When a central bank hints at raising rates, the currency often rallies as investors scramble to get a piece of the pie. Conversely, lowering rates is like opening a pressure valve, usually devaluing the currency to stimulate a sluggish economy. Understanding fundamental analysis means shifting your perspective from what is the price doing to why is the price doing this. By keeping a close eye on interest rate decisions and economic indicators, you begin to see the Forex market not as a series of random zigzags, but as a logical reaction to the world's shifting financial landscape. You are no longer just a spectator watching candles flicker on a screen. You are a strategic observer of the global stage, anticipating the moves of the world's largest economies before they even take their first step. Chapter 16, Trading the News, Managing Economic Volatility. In the world of Forex, the economic calendar isn't just a schedule. It is a weather map for a brewing storm. For the uninitiated, high-impact news events can feel like sudden, violent gusts of wind that rip through a stable trend, triggering stop losses and liquidating accounts in a matter of seconds. To the professional, however, these moments of volatility are the heartbeat of the market. Trading the news is the art of navigating these bursts of energy without letting your ship capsize. It requires a shift in mindset. You are no longer just looking at candlestick patterns, but peering into the fundamental gears of global power, central banks, employment data, and the raw pulse of national economies. At the center of this hurricane sits the big three: interest rate decisions, the Consumer Price Index, CPI, and the legendary non-farm payroll, NFP. Every first Friday of the month, the NFP report drops like a gavel, revealing the health of the U.S. labor market and sending the U.S. dollar into a frenzy of activity. During these releases, the spread, the cost of entering a trade, can widen significantly, and price action can gap over your predefined exit points. This is why the first rule of news trading for beginners is often the hardest to follow. Sometimes, the most profitable move you can make is to simply close your platform and watch from the sidelines. Managing economic volatility begins with a disciplined ritual of checking the calendar before your first cup of coffee. You must learn to distinguish between the background noise of low-level reports and the red folder, events that act as catalysts for massive institutional shifts. When a central bank raises interest rates unexpectedly, it isn't just a number on a screen. It is a fundamental revaluation of a currency's worth. By understanding the timing of these announcements, you move from being a victim of the market's movements to a calculated observer, ready to capitalize on the exhaustion of the move rather than getting caught in the initial explosion. Safety in these high-stakes moments is built on the foundation of capital preservation. In this chapter, we will demystify the mechanics of the economic calendar and explore the straddle and fade techniques, strategies designed to protect you from the whipsaw of erratic price swings. You will learn how to wait for the initial dust to settle, allowing the big banks to show their hand before you commit your own capital. Trading the news is not about gambling on the outcome of a report. It is about managing the reaction to it with surgical precision and ironclad discipline. Chapter 17, Risk Management, How to Stay in the Game. The glamorous side of trading, the flashing green numbers, the exotic lifestyle, and the thrill of the winning trade is what draws most people to the markets, but it is not what keeps them there. The hard reality of Forex is that you are not just a speculator. You are a risk manager. Every legendary trader knows a fundamental truth that the novice ignores. Your primary job is not to make money, but to protect what you already have. Without a disciplined approach to capital preservation, even the most brilliant strategy is nothing more than a slow-motion countdown to a zero balance. Central to this survival mindset is the 1% rule, a cornerstone of the professional's arsenal. It dictates that you never risk more than 1% of your total account balance on any single trade. This reflects a shift from emotional gambling to mathematical probability. By strictly limiting your downside, you ensure that a string of losses, which is statistically inevitable even for the best, becomes a minor setback rather than a catastrophic failure. In this game, the person who can weather a dozen small losses without flinching is the one who remains standing when the tide finally turns. However, protecting your capital is only half the equation. The other half is understanding the geometry of growth through risk to reward, RR ratios. A successful trader doesn't need to be right all the time. In fact, many are wrong more often than they are right. By ensuring that every dollar you risk has the potential to return $2 or $3 in profit, you tilt the math in your favor. This asymmetrical approach means that a single win can erase multiple losses, effectively decoupling your success from your ego. You stop chasing the big win and start focusing on the spread between your risks and your rewards. Ultimately, internalizing the math of risk management transforms trading from a roller coaster of anxiety into a calculated business operation. It requires a fundamental shift in perspective. You must learn to love your losses, or at least respect them enough to keep them small. Chasing profits is a sprinter's game, but wealth in the Forex market is built by the marathon runners. By mastering these rules, you aren't just learning how to trade, you are learning how to stay in the game long enough for your edge to manifest and your capital to compound. Chapter 18, Position Sizing and Capital Protection. Imagine for a moment that your trading account is a fortress. In the heat of market volatility, many traders focus exclusively on how many arrows they can fire at the target. But true professionals are obsessed with the thickness of their walls. Position sizing is the architectural blueprint of that fortress. It is the bridge between a reckless gamble and a calculated business decision. Without a standardized approach to how much capital you commit to a single trade, even a high win rate strategy can lead to a catastrophic margin call during a normal string of losses. By mastering position sizing, you shift your focus from the fluctuating dollar amount of a win to the controlled mathematical percentage of your risk. The secret to longevity in the Forex market lies in a simple paradox. You must treat every trade as if it might be a loser. To do this, you must decouple the distance of your stop loss from the amount of money you are willing to lose. Most beginners make the mistake of trading a fixed lot size, say 1.0 standard lot, on every single setup. However, if one trade requires a 20 pip stop loss and the next requires a 60 pip stop loss, the second trade is inherently 3 times as risky as the first. True capital protection means that whether your stop loss is wide or tight, the hit to your account balance remains exactly the same, whether that is 1%, 2%, or a fraction of a percent of your total equity. To achieve this precision, you must employ the position sizing formula: account balance, risk percent. FLAF, stop loss in pips, pip value. This calculation ensures that your lot size scales dynamically according to the volatility of the specific setup. If the market requires a wider buffer to allow the trade room to breathe, your lot size will naturally decrease. Conversely, a tight, high-conviction setup allows for a larger lot size without increasing your net exposure. This isn't just math, it is a psychological shield. When you know exactly what is at stake before you click buy or sell, the emotional pressure of the market's movement begins to evaporate, leaving you free to execute your plan with the cold objectivity of a machine. Chapter 19, Defining Your Trading Style. Trading is not a one-size-fits-all endeavor. It is a mirror self-portrait of your personality, your patience, and your daily schedule. Before you place another trade, you must ask yourself a fundamental question. Who are you when the market is moving? Some traders thrive on the adrenaline of rapid-fire decisions, while others find peace in the slow burn of long-term trends. Choosing a trading style is about more than just profit targets. It is about finding a pace that you can sustain without burning out. If you choose a style that conflicts with your natural temperament or your professional life, you aren't building a business. You're creating a second, much more stressful job. If you are someone who craves constant action and possesses razor-sharp focus, you might find your home in the world of scalping or day trading. Scalpers live in the seconds and minutes, capturing tiny price movements many times a day, while day traders ensure every position is closed before the sun sets. These styles require a significant time commitment during market hours and a high tolerance for quick decision-making. It is a high-intensity environment where the goal is to stack small wins into a mountain of profit, but it demands that you tether yourself to the screen and remain unfazed by the noise of the lower timeframes. On the other hand, for those with full-time careers or a preference for big-picture thinking, swing trading and position trading offer a more measured approach. Swing traders hold positions for days or weeks, looking to capture the meat of a market move while ignoring the minor fluctuations that distract day traders. Position traders go even further, acting more like investors who navigate the fundamental shifts of global economies over months or even years. These styles prioritize patience over activity. By stepping back from the charts, you gain the freedom to let the market do the heavy lifting while you live your life, making these the ideal choices for those who want their capital to work for them, rather than the other way around. Ultimately, the best style is the one you can execute with discipline day after day. A parent with a busy household may struggle to scalp effectively, just as a hyperactive personality might go stir-crazy waiting 3 weeks for a swing trade to hit its target. As you move through the specifics of each style in this chapter, pay close attention to your internal reaction. When you imagine yourself in the trade, do you feel a sense of control or a sense of anxiety? Your success in the Forex market will be determined not by the style with the highest theoretical return, but by the style that allows you to remain calm, consistent, and collected in the face of uncertainty. Chapter 20: Crafting Your Professional Trading Plan. The transition from a retail hobbyist to a professional trader is cemented by a single physical document, your trading plan. Without it, you are merely a gambler following the shifting winds of intuition. With it, you are an executive operating a systematic business. A professional trading plan serves as your constitution, a comprehensive set of laws that governs your behavior when the market becomes volatile and your emotions begin to flare. It removes the burden of thinking in the heat of the moment, replacing hesitation with a predetermined script. Before you click another button on your terminal, you must commit to the idea that if a setup is not written in your plan, it simply does not exist. The architecture of your plan begins with the rigid definition of your entry criteria. This is your if-then logic, stripped of all ambiguity. You must document the exact alignment of indicators, price action patterns, and timeframes required to trigger a position. Are you waiting for a specific candle close? Does the RSI need to be in a particular zone? By defining these parameters in advance, you eliminate the fear of missing out that plagues many beginners. Your entry rules should be so clear that a complete stranger could look at your chart and tell you, without a doubt, whether a trade should be taken. Just as critical as how you enter is how you protect your capital and extract your profits. A plan without an exit strategy is a ship without a rudder. You must predefine your point of invalidation, the exact price at which your trade idea is proven wrong, and place your stop-loss there without exception. Simultaneously, you must determine your profit targets based on logical market structures rather than greed. By deciding exactly where you will exit before you ever enter the market, you neutralize the two most dangerous forces in trading: the hope that a losing trade will turn around, and the anxiety that leads to cutting a winning trade too early. Finally, your blueprint must include the often overlooked filters, or the rules for when not to trade. Professionalism is defined as much by the trades you skip as the ones you take. This section of your plan should list the conditions that keep you on the sidelines, such as major high-impact news releases, periods of low liquidity like bank holidays, or personal states of mental fatigue and stress. Recognizing when the statistical edge is no longer in your favor is the ultimate form of discipline. As you formalize these rules into a repeatable curriculum, you cease being a victim of the market's movements and start becoming the master of your own execution. Chapter 21: Trading Psychology: Winning the Inner Battle. The market does not care about your mortgage, your ego, or the hours you spent analyzing a 4-hour candle. It is a cold, indifferent ocean of liquidity that moves according to forces far larger than any single participant. While the first half of this curriculum focused on the mechanics of charts and indicators, the tools of the trade, we now enter the arena where most traders actually fail: the 6 inches between their ears. Trading psychology is not a soft skill. It is the fundamental infrastructure upon which every successful trade is built. Without it, even the most sophisticated strategy is nothing more than a high-speed vehicle with a broken steering wheel. Fear and greed are the twin predators of the Forex market, and they often hunt in tandem. Greed whispers that you should double your lot size after a win, blinding you to the risk as you chase a sure thing. Fear, on the other hand, paralyzes you at the exact moment your setup appears, or forces you to close a winning trade prematurely just to stop the anxiety of a fluctuating profit. These are biological impulses, remnants of a primitive brain designed for survival, not for the abstract risk of currency speculation. To succeed, you must learn to recognize these emotional tells before they dictate your keyboard strokes. Perhaps the most dangerous psychological trap is the revenge trade. After a painful loss, there is a primal urge to strike back at the market, to get it back by immediately re-entering a position with higher stakes. This is the moment a trader transforms into a gambler. Revenge trading is born from a refusal to accept the reality of a loss, treating a failed setup as a personal insult rather than a statistical inevitability. Winning the inner battle means detaching your self-worth from your P&L statement. It requires the discipline to walk away from the screen when your emotions are running hot, knowing that the market will still be there tomorrow. Developing a trader's mindset requires shifting from a results-oriented focus to a process-oriented one. You cannot control whether a specific trade hits your take profit or your stop loss, but you can control whether you followed your plan to the letter. This chapter will provide you with the psychological scaffolding needed to remain objective under pressure. By implementing strict mindfulness techniques and maintaining a rigorous trading journal, you will learn to view losses as the cost of doing business rather than a failure of character. True mastery in Forex isn't about predicting the future, it's about mastering yourself. Chapter 22: The Importance of the Trading Journal. If trading is a business, then your journal is your ledger, your strategist, and your most honest critic combined into one. Most beginners treat trading like a series of disconnected events, isolated bets placed in a vacuum, but the professional knows that every trade is a single data point in a much larger narrative. Without a journal, you are wandering through the financial markets with a blindfold on, repeating the same subconscious errors until your account is depleted. By documenting every move, you transition from a gambler hoping for luck to a scientist refining a repeatable experiment. A truly effective spreadsheet or notebook goes far beyond just recording bought or sold. To build a legitimate blueprint for success, you must capture the anatomy of the trade. This starts with the technical evidence, the entry price, the logic behind the stop loss, and a screenshot of the chart at the moment you click the button. Visual evidence is vital because it allows you to look back weeks later and see the market through your past eyes. Did you actually follow your strategy, or did you manufacture a reason to enter because you were bored? This objective data reveals the bridge between who you think you are as a trader and who you actually are when the money is on the line. Furthermore, a journal is the only place where you can quantify the invisible forces of psychology and risk management. Tracking your R multiple, the ratio of what you risked to what you earned, allows you to see if your edge is mathematically sound over time. Alongside these numbers, you must document your emotional state. Writing down that you felt restless or anxious during a trade often reveals more about your performance than the candle patterns themselves. Over time, these entries become a mirror, transforming your past mistakes into a customized playbook for future profits. In the world of Forex, the person with the most data isn't just the most informed, they are the most disciplined. Chapter 23: The Demo Phase: Practicing Without Risk. The transition from theory to execution is often where the aspiring trader feels the most friction. You have studied the candlesticks, memorized the patterns, and built a strategy that looks flawless on a static chart. However, the moment you step into the live stream of the global marketplace, the psychological weight of potential loss can paralyze even the sharpest mind. This is where the demo account serves as your flight simulator. It is a sandbox environment that mirrors the real-time movement of the currency markets, allowing you to pull the trigger on trades using paper money. In this phase, your goal is not to get rich, but to achieve mechanical proficiency, learning how to navigate the platform, set stop losses, and manage positions without the haunting specter of financial ruin. Treating a demo account with the same respect as a live account is the hallmark of a disciplined trader. It is easy to become reckless when the capital isn't real, taking outsized risks or ignoring your rules because there are no real-world consequences for failure. But if you gamble with play money, you are simply reinforcing bad habits that will inevitably bleed your real bank account dry later. Use this time to build your muscle memory. Every click should be intentional. Every entry should be backed by your checklist, and every loss should be analyzed with the same rigor as if it had cost you a week's wages. You are not just practicing trading. You are practicing the person you intend to become when the stakes are real. Once you have achieved a streak of consistency in the demo environment, the leap to a standard live account can still feel like a chasm. To bridge this gap, we utilize the micro account transition. This stage involves trading with real capital, but in such small increments, often just cents per pip, that the emotional impact of a loss is minimized while the psychological reality of skin in the game is activated. It is the final testing ground where you prove that your strategy can survive the transition from the laboratory to the wild. By moving through these stages, from demo to micro to standard, you build a foundation of confidence that is earned through experience rather than blind hope. Chapter 24: Common Pitfalls and How to Avoid Them. The transition from theory to practice is often where the most disciplined students face their greatest reckoning. In the world of Forex, the most dangerous enemies you will encounter aren't the large institutional banks or the volatility of the geopolitical landscape. They are the subtle, psychological traps wired into the human brain. Most beginners enter the market expecting a battle of intellect, only to realize they are in a battle of temperament. This chapter serves as your tactical map through the minefield of amateur errors, the common pitfalls that have claimed the accounts of countless traders before you. Perhaps the most seductive of these traps is revenge trading, a visceral reaction to a losing streak that clouds judgment with anger. It begins with a sting, a stop loss is hit, and suddenly the market feels like an adversary that has stolen something from you. In an impulsive attempt to win it back, you force a new position with increased lot size and diminished logic. This is no longer trading, it is a high-stakes pursuit of emotional validation. To avoid this, you must accept that the market owes you nothing. A loss is not a personal insult, it is merely a business expense, a statistical certainty that must be met with a calm shrug rather than a clenched fist. Equally treacherous is the phenomenon of system hopping, the endless quest for a holy grail, strategy that never experiences a drawdown. It usually follows a predictable cycle. A trader learns a strategy, experiences 2 or 3 losing trades, decides the system is broken, and immediately discards it for a new one. By jumping from a trend-following method to an oscillator-based strategy every time the wind changes, you never allow the law of large numbers to work in your favor. True mastery comes from sticking with a proven edge through its inevitable quiet periods, rather than constantly resetting your learning curve in search of a perfection that does not exist. Finally, you must guard against the silent account killer, overtrading. This is the result of a more is better mindset, where a trader feels that every hour spent away from an active position is a wasted opportunity. In reality, some of the most profitable moments in a professional's career are those spent sitting on their hands, waiting for high-probability setups to arrive. Overtrading dilutes your edge and inflates your transaction costs. By learning to differentiate between a valid signal and a boredom-induced impulse, you move from being a reactive participant to a focused predator. Recognition is the first step toward avoidance. Understanding these traps now ensures you won't have to learn their lessons through a depleted balance. Chapter 25: The Path to Consistency and Beyond. The transition from a student of the markets to a professional participant is rarely marked by a single explosive windfall or a sudden moment of enlightenment. Instead, it is a quiet evolution defined by the shift from seeking excitement to prioritizing execution. To cross this threshold, you must begin to view your trading terminal not as a game of chance, but as the primary machinery of a business. This means moving beyond the mechanical application of rules and entering the realm of professional risk management, where the preservation of capital is just as vital as its growth. You are no longer chasing pips, you are managing a portfolio. Treating trading as a professional enterprise requires a rigorous commitment to the mundane details that amateurs often ignore. A hobbyist trades when they feel inspired. A professional trades because their criteria have been met, regardless of their emotional state. This blueprint for long-term growth demands a comprehensive feedback loop, a meticulously maintained journal, a weekly performance review, and a clear set of key performance indicators, KPIs. By stripping away the ego and focusing on the data, you transform your trading from a series of disconnected bets into a scalable, repeatable process that can withstand the inevitable ebbs and flows of the global economy. Scaling a small account is the next frontier in this journey, and it requires a delicate balance of patience and discipline. Many traders fail here by over-leveraging in an attempt to turn hundreds into millions overnight, only to succumb to the psychological weight of increased risk. Professional growth happens through compounding confidence, gradually increasing your position sizes only as your equity curve and emotional resilience prove they can handle the load. As you scale, your strategy remains the same, but your mental fortitude must broaden. You are building a skyscraper. The taller you want it to reach, the deeper and more stable your foundational habits must be. Finally, remember that the curriculum of the markets is never truly completed. The most successful participants are lifelong students who understand that financial landscapes are in a constant state of flux. Beyond this roadmap lies a commitment to continuous education, studying new correlations, refining your edges, and adapting to shifting volatility. The blueprint has provided you with the structure, but your longevity will depend on your ability to remain a humble observer of the price action. Your education phase may be ending, but your career as a professional market participant is only just beginning.